Hey traders, welcome back to another video. Today we're talking about PMI numbers and why this lead indicator is such a powerful tool for traders looking to incorporate fundamental analysis or macroeconomics into their trading strategies. So today we are talking about the PMI number, or the Purchasing Managers Index. And again, this is often an overlooked indicator in the market that can be very, very useful when trying to understand the state of a country's economy. Now, most of the G7 nations, many of these countries present their PMI numbers in the form of manufacturing and services, the two sectors. And in this video, we're going to break down what it is, how it can help you, and how it actually can impact your trading. So let's go ahead and dive in. First of all, what is the PMI number? Like I said, it stands for Purchasing Managers Index. And when we ask ourselves, well, what does this data actually tell us? Well, it's the purchasing manager's decision-making process that we're really after. Are they looking to hire more people? Are they looking to purchase more goods and basic materials and, all of their sort of behaviors? If you're a purchasing manager for a big company, that is a lead indicator. That's telling us, well, how much demand do these people have for labor, things like that. And understanding what those purchasing managers are up to can be really important for showing what the economy is looking like. So it's all about the purchasing managers here. Their outlook shows expansion or contraction in their business and where they think things are going. They're just doing their business, and on a grand scale, if you took an index of these people, that could show us what the economy outlook is looking like in the, again, services and the manufacturing sectors respectively. Both of them present, both of them we have PMI numbers to look at. And again, as I mentioned, this is a lead indicator because this is showing the active purchasing, the active, discretionary spending that is going on from these purchasing managers. So in terms of reading the actual index, it's really quite simple. The number comes out, and what you can see here is that we get a forecast, and you can see the number was 52 expected. It came out 53.4 today. Now, what this means is that if this number is above 50, it means that the services sector was expansionary. And this is, of course, the actual number. So we can see we saw expansion, and it was even more so than what the forecast was. So showing some nice growth in the services number. So it's really simple to read these numbers. If the services and the manufacturing PMIs, which again, they present in two different data points, if that number is above 50, it shows expansion, and if that number is below 50, it shows contraction. Again, generally a strong economy, you'll see higher readings in the PMI numbers for services and manufacturing. So now we get into some of the fun parts. How does this impact the charts? How does this impact us as traders? What does this tell us about financial markets and where things might be going? Well, if you get strong PMI numbers, let's say that you see, again, the purchasing managers index is real strong. Let's say we get, again, what we just saw, the services PMI just a moment ago, 53.4. That would tell us that there was expansion in the services PMI. And so what does this actually entail for the stock market, for gold, for the currency of the respective economy? Because as I mentioned earlier, remember, this is not just the US that reports these numbers. Germany and France and all these countries, they put out their numbers as well. Basically, the idea here is that if PMIs are strong, generally what we see is that it's good for stocks, right? It's good for companies because strong growth is going to equate somewhere along the line to, for the most part, strong earnings. And if you're, trading the stock market in the long term, stocks kind of trend towards their respective earnings growth. If you see lots of earnings growth, it's going to be good for stocks. So good PMIs are usually a good sign for the economy, and hence more spending and more profitable companies. So they're good for stocks usually, and it's also good for the country's currency. Why might that be? Well, again, think about it this way. If we're talking about the US's PMIs, for example, if you see strong numbers there, it shows that the economy is strong, and some safety can be found perhaps in the US dollar, again, strong PMI numbers, strong US dollar. It's pretty straightforward on that respect. It's also usually good for oil when you see countries presenting strong PMI numbers. Why would that be? Well, let's think about it. Strong PMIs showing strong economic growth those economic growth figures are also going to equate to more demand for oil, right? So again, if you're thinking about, economy that's doing very, very well, think about like China or the US, if they're doing really well, or Europe, they're going to demand a greater amount of oil to continue to propel their economy. So again, usually a positive thing for the oil market as well. And what about gold? Well, gold is actually the opposite. We usually see strong PMI numbers strengthen the currency, remember, which can weaken gold overall. So if we're thinking about gold against the US dollar, a strengthening dollar will put pressure on the metal. So now let's flip the script here and we can think a little bit about PMIs being weak. What happens if you see economic contraction? Well, of course, in this case, we would flip everything around. We would say, well, for stocks, that's not good because, a weakening economy, less hiring, less people getting, wage increases and companies spending less money. That's going to be not as stimulating for stocks and for companies because, of course, again, there's sort of that lessening demand. So again, that also would be not so great for the country's currency, right? Again, it would take away some of the safety factor or the strength factor of an economy if, again, the economy is pointing towards contraction. This is also good for gold for the very same reason. If you see an economy kind of contracting, it's usually going to cause people to be a little bit more hesitant about that country, especially if you're really in severe contraction territory. Think about like 2020. That was a real tough time in the economy, and a lot of people went into gold as sort of that safe haven out of concern for the economy. And finally, it's also bad for oil because think if a economy expanding is good for oil, and expanding a contracting economy would be, of course, bad for oil. Okay, so we've spent all this time talking about the PMI data. Let's actually look at it really quick. So what we're looking at is the Edgefinder Pro. This is my company's software that helps us visualize market data. We're looking at the PMI data tab here. And what we can see here is we've got PMI, both manufacturing and services. Remember, these two numbers report respective to one another, independent from one another. What we can see here is that there is sort of this squiggly line where during certain periods we see a higher read in the economy and other times you see lower reads. Like for example, you have, I mentioned this earlier, but remember that in 2020, we saw that, of course, the COVID-19 pandemic led to a huge contraction in the services PMI number. And we don't have that data going back as far on the manufacturing here, but you can see it in the services. And so you saw a massive slide in the services PMI as, again, lots of people got let go, a lot of orders kind of dried up, and a lot of, obviously from this number, the Purchasing Managers Index shows us that there was a huge contraction in that area of the economy. And it also happened in manufacturing, by the way, as well. Now, so here's the thing. How does that help you? Well, again, during this time, remember I mentioned that was really positive for gold. That drop off made gold go skyrocketing high shortly after. And then we had periods of time where the economy was really, really strong. After all the stimulus that happened, we saw a really, really strong economic read. And you can see we've been cooling overall, which has been sort of the Fed's objective with trying to get inflation down. So we've seen that kind of playing out over time here as well. And again, right now we're sitting around 51 and 50 at the time of recording this video. Of course, if things, sort of continue to grow and outlook is better, we'll see that number rise. And if things start to shrink, we can look here and see it fall. So again, PMI data can be easily visualized within the Edgefinder. And I should mention, if you'd like a trial of this software, you can find one down below in the description if you'd like to use our tool to access this data, as well as retail sales and all sorts of other video topics that we've done. All of the data can be visualized directly within our platform, the A1 Edgefinder. So if you don't have a copy of this, make sure to try one out by clicking the link down below in the description. All right, guys, now it's time for the bonus round. What if inflation is high and we see strong PMI numbers come out? What does that do to stocks? Think about this for a second inside your head. Pause the video if you need to, and I'll tell you the answer. Okay, you ready? Here's the answer. If inflation is hot and you continue to see an economy being very, very strong, that actually can decrease the outlook or make a more pessimistic outlook for the stock market. Sounds kind of confusing at first, but go with me here for a second. If the PMI numbers are showing a lot of growth leads to a lot of inflation, and high levels of inflation and perpetuating more inflation can lead to a central bank needing to raise rates dramatically, not cut them, but raise them dramatically to combat that inflation. Raising interest rates, tightening the monetary policy can be really restrictive to businesses and can cause a huge slide in the stock market. Remember that stocks are always looking ahead, and so really hot PMI numbers in a high inflationary period could lead to a melt-up event, which could ultimately lead to some really severe recessions and bad stock reports, right? So something to think about there. If the topic of inflation or how central banks play a role in all this would be useful to you, in the top right hand of the screen right now, we'll link another video that was relevant to that topic to help you out. And one last freebie here as we end today's video, we do have a free Telegram channel down below. If you'd like fundamental analysis-based trading setups and ideas sent directly to your phone or to your desktop, totally free, find the Telegram channel linked down below in the description. If this video helped you in any way, shape, or form, make sure to hit that thumbs up button, and we'll see you next time. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel, and we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.